Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dinesen.
Welcome to another episode of Accounting in the Wild, brought to you by MyCPE1. My name is Jason Dinesen, flying solo this time around, and let's jump right in with our topic, which is summertime planning. Some things that should be done now if you're a tax pro talking to your clients, or if you are a taxpayer listening to this, some things you should be thinking of. Energy credits are going away. The IRS is no longer going to be accepting checks. That's coming soon. If you have kids, sending your kids to summertime camps and such, how much of that counts for a tax credit? Plus, one big beautiful bill changes to the daycare credit. Where do deductions for things like overtime and tips go? The big beautiful bill has brought us a new deduction for those things. Where does it go? And then we'll also talk a little about data security, in particular, the written data security plan, the written information security plan that tax pros are supposed to have in place. So that's what we're going to talk about today. Energy credits going away as of either September 30th or December 31st, depending on what exactly we're talking about. Now, there's actually a lot of energy credits that are going away. The credits under Section 45 of the tax code, many of which apply to businesses, those are going away, most of them anyway. But what we're talking about here are things that affect kind of your Mr. and Mrs. Jones type of clients. So the electric vehicle credit, both the $7,500 credit for new electric vehicles and the $4,000 credit for used electric vehicles, both go away for purchases after September 30th of this year. So the clock is ticking on that. If someone purchased an electric vehicle earlier this year, they can still claim the credit on their 2025 tax return. After September 30th, though, they're out of luck. So then also we need to talk about the two different credits that are available to individuals for things like energy efficient windows and doors, and the credit for things like solar and geothermal. So the credit for energy efficient windows and doors and appliances, a few years ago, they added the ability for you to claim home energy audits by the utility company toward the credit. This is the credit that used to at one time have a $500 lifetime limit. And then the limit got increased a few years ago to either $1,200 a year or $2,000 a year, depending on the exact nature of what you were doing. That goes away for any purchases after December 31st of this year. So if someone's thinking about, installing some new windows or doors and they want to get a little tax credit, get it done by December 31st. The other credit that's going away is the credit for things like solar and geothermal. And that's a much bigger credit. That's 30% of the cost with no cap. So a lot of those projects cost tens of thousands of dollars, and with a 30% credit, you could get tens of thousands of dollars of credit. That goes away after December 31st as well. One other energy efficient note that I wanted to just pass along, because we had Randy Eichhoff from Ascena Consulting as our guest about a month ago now. Randy was talking about cost segregation studies, but he also briefly mentioned section 179D, 179 capital D. The 179D deduction is going away as well, and that's going to go away for any projects where construction starts after June 30th, 2026. So that's some energy efficient notes. Basically, the energy efficient credits, electric vehicle credits, it's all going away. It's a question of which date, when is it going away? But in particular, the electric vehicle dates are looming. Something else that's coming up now, this has nothing to do with the big, beautiful bill. The energy credit stuff, that's all big, beautiful bill that did that. But this other thing that's changing September 30th has nothing to do with the big, beautiful bill. But I think it's a big deal, and that is the IRS is no longer going to accept paper checks after September 30th, nor will they issue refund checks after September 30th. And that's one of those sneaky big deal kind of things. I think about when I was practicing, the clients who like to mail checks. They like those payment vouchers and they want to mail their estimated payments off to the IRS. You'll still be able to mail your third quarter estimates. Those are due September 15th. You'll be able to mail those with a check. But after that, you're going to have to figure out a different way to pay the IRS. Now, if you're paying, let's back up. What are your options? So if it's an estimated payment, I would use direct pay. In fact, that's what I used to use. Now I have an ID.me login on the IRS website. So if I ever need to pay anything to the IRS, I just log into my account and make a payment that way. By the way, sometime earlier, I think it was earlier this year, the IRS opened up businesses to be able to use direct pay. And so even for things like paying payroll taxes, when I was practicing, I had some smaller clients who they would file their 941 each quarter. And their payroll liability was low enough to where they didn't have to make payments electronically. So they would mail a payment voucher along with the 941. Won't be able to do that anymore. In fact, the third quarter 941 is due October 31st, which means for 941s, that ain't going to work anymore to mail a check. And I'm thinking about things also like the 940 unemployment tax. For some businesses, that could be as low as literally like $42. Due in January, even if you're mailing the form itself in, you're going to have to come up with a different way of paying than mailing a check. It's also going to affect people on extension filing their tax return by the October 15th deadline. If they file after September 30th, they won't be able to pay using a check, nor will the IRS send them a check as a refund. So that's just another little planning thing, and maybe figuring out how to have conversations with your clients, especially those who like to mail checks for their quarterly estimates. Well, it is summertime, so that means maybe sending your kids off to day camps or other activities in these summer months. Don't forget to include those in your daycare costs for tax time next year. or at least don't forget to think about them for daycare costs. You're still, daycare costs for one child, $3,000, two or more, $6,000. That's what you base the credit off of. You might max out that credit just with regular old daycare costs, in which case things like sending your kid to camp in the summer, you might technically be able to count it, but it's not going to do you any good because your credit is already maxed out. But if you need some extra expenses to get more credit to get up to that 3,000 or 6,000 limit, day camps count. Overnight camps do not. So if you're sending your kid away to one of those camps or they go away for 2 weeks, that doesn't count. But a day camp, like going to the science center or something, that does count, as long as it's so you and your spouse, if married, can work or look for work. So don't forget to account for those. The one big beautiful bill is also making changes to some daycare credit things. The technical name is the Child and Dependent Care Credit for 2026. Not for 2025. So for a very long time, the maximum credit has been 35% for people with less than 15,000 of adjusted gross income. And then the credit declined steadily from there until it reached 20% at over 43,000 of adjusted gross income. Starting next year, those credit amounts are increased by 15%. So the maximum credit is 50% for people with AGI of less than 15,000. Hold that thought, by the way. I'm going to come back to that in just a minute. Then it phases down until it reaches 35% for people whose AGI is over 43,000. So for a lot of folks, they're going to get a 15% boost in the credit. Then there's another phase out when adjusted gross income reaches 150,000 for married filing jointly, or 75,000 for all other filing statuses, where that 35% credit starts to be reduced until it reaches 20%, and then it levels off. I said hold that thought on the fact that people with AGI of less than 15,000 can claim right now a 35% credit, and starting next year a 50% credit. Whether you're filing a single or head of household, if your AGI is 15,000, you have no taxable income. In fact, for quite a stretch there, you're going to have no taxable income. A lot of people with kids are going to be filing as head of household, where the standard deduction is $23,625, I think is what it is for 2025, as it was reset in the big beautiful bill. If your taxable income is zero, you get no benefit from your child and dependent care expenses. Now, it is nice, though, for a lot of folks that the credit amount is being bumped up for a lot of people. That is helpful, but it's still based on 3,000 or 6,000 of expenses. That part has not been adjusted at all for inflation. So someone asked me recently, why doesn't Congress do anything with that, with allowing more expenses toward the credit? And as I always say, when people ask me why, it's like, I don't know. You'd have to ask Congress about that. Also on daycare, you have the dependent care benefit programs that some employers offer. Right now, the maximum you can put into that is $5,000. Starting next year, 2026, that goes up to $7,500. And those daycare flexible benefit programs are an excellent thing to use. One thing that I haven't done is run the numbers on seeing if anything changes with the fact that the credit amount is boosted for a lot of folks, if that changes some of the calculus on whether the flexible benefit plan is better or not. But under the current regime, the current system, it's usually much better for people to use the flexible benefit plan through their employer than to claim the credit. And so starting in 2026, you can put up to $7,500 into such a program. Where do deductions for overtime and tips, where do those deductions go? Starting this year, many people who receive tips and overtime pay can take a deduction for their tips and overtime, or at least for some of it. Where does that deduction go? There's been some information out there on some social media posts, even some posts from tax pros that are wrong about this. Some people have said that these are what are called above the line deductions, which means it reduces your adjusted gross income. That's not the case. The big beautiful bill says that these deductions are below the line. They come after adjusted gross income is calculated. So it's basically in addition to the standard deduction or itemized deductions. Now, you're still getting a deduction, and that's nice, but the one thing to think of on this is if you're trying to get your adjusted gross income down because AGI keys to so many other things on the tax return, the deduction for overtime and tips isn't going to do it. And in fact, the way that deduction works is the overtime and the tips, they have to be counted as income. So they're going to end up on the W-2. You'll claim it as income. It's going to increase your adjusted gross income. The deduction for overtime and tips comes off of taxable income, not off of your AGI. So if you're doing tax planning and you're thinking about your adjusted gross income, don't count the deduction for overtime and tips as a reduction to your AGI. It reduces taxable income, but it's not going to reduce your AGI. Same thing with the new deduction that's available for car loan interest. That deduction is not an itemized deduction. Anyone who qualifies can deduct car loan interest. The qualification there, among other things, is no more than $10,000. It has to be a brand new vehicle made in America. That's kind of the shorthand version of it. That is also something that will be deducted from taxable income. It will not reduce your adjusted gross income. Starting next year, non-itemizers will be able to deduct charitable contributions, $2,000 if married filing jointly, $1,000 for all other filing statuses. That also will not reduce adjusted gross income. That's basically in addition to your standard deduction. So again, that's planning. That's something to think about because a lot of times you want to get your AGI down because that's going to help you out in a lot of other places on your tax return. Being able to take the deduction, of course, is good. So you're going to get a benefit, but your AGI will not benefit from things like the deduction for overtime and tips. I also wanted to quickly talk about data security plans, the written information security plan. We talked about this on our last episode with Nick Mullen from N2 Security, but I wanted to bring it up here too because it's summertime, which means that we have more time to stop and think about things. And one of the things we have to do is have a written information security plan in place. That's a requirement of the Federal Trade Commission. In fact, when you renew your PTIN every year, the small print of the things that you agree to, the small print says that you have a written information security plan. This can be really intimidating to try to even think of where to get started. When I did mine, I used a checklist in an IRS publication. Now, I was always a solo operator, so my written data security plan, is pretty straightforward. If your business is a little bigger, it could get more complicated. Well, now the IRS, this was a year or two ago now, they rolled out Publication 5708, which actually has a template. Now, here's the thing, as we talked about last time with Nick Mullen from N2 Security, that template can get kind of deep in places with the terminology, but it is a good starting point. And depending on the nature of what you need for your information security plan, it might be enough. Otherwise, it might not hurt to spend some money to have someone like Nick put together your information security plan. I promise this isn't a sales pitch for his business. I'm not being paid to say this. It's just something that I think is important, and that's why I'm bringing it up. If you have not watched or listened to that episode, it's our prior episode before this, check it out. We still have a couple of minutes here, so let's talk also about one of the things you may have seen and whether it's true, and that is no tax on Social Security. The big, beautiful bill eliminates taxation of Social Security. That is, I would rate that as mostly false. In fact, I guess technically, we probably could rate it as completely false because the big, beautiful bill didn't change anything with like the calculations of the taxable portion of Social Security. All of that is the same. What the big, beautiful bill did, what it did do is, for people age 65 and older, it temporarily created for 2025, I almost said '05. For some reason, I'm living like 20 years ago. 2025 through 2028, it creates a temporary $6,000 exemption deduction for people age 65 or older. So in that regard, people age 65 or older, if you're on Social Security, you get an extra $6,000 deduction. It's not specifically like a reduction in Social Security benefit taxation or anything like that. It's just a deduction that you get. So is it true that the big, beautiful bill took away taxation of Social Security? No. What it did do is it created a temporary exemption deduction for people age 65 or older. So that'll do it for this episode of Accounting in the Wild. Join us again next time. These episodes, as always, are brought to you by MyCPE1. If you want to get credit for watching or listening to this episode, if you're a tax pro and you need continuing ed hours, head over to my-cpe.com and you can get your CPE hours, and you can also find 15,000 hours of other CPE and continuing ed content at MyCPE1, my-cpe.com. Thanks so much for joining us. I'm Jason Dinesen. Goodbye, and we'll talk to you again soon.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dinesen.